Let us zoom out a little bit, literally, but also figuratively. Why do we not own all of our funds 100% in Bitcoin? Why do we also have shares? Why do we also have precious metals and property? Why do we even have this diversification? The idea is, of course, every single asset can be risky. And especially with crypto, especially with Bitcoin, the volatility can be massive. Bitcoin can drop by 60, 70, 80%. However, maybe there's a way to get more exposure to the fastest growing of the asset classes without all the risk. In the end, it's all about risk-adjusted return. We want to get as much return as possible with as little risk as possible. So it's not about being a risk taker, it's about taking as little risk as possible while maintaining the performance. And so what we see over here is Bitcoin's long-term chart. And Bitcoin had fallen more than 90% over here, more than 80% over here, then again another 80% drop over here. And just recently we went from more than 70k to 15k, a drop of a bit under 80%. And so that begs the question, is there at least a way to partially reduce those drawdowns? Is there a way to time the market to a degree? I'm not saying that we have to time the top perfectly. I'm not saying that we have to buy the absolute bottom, but is there maybe a way to be at least somewhat better than just buying and holding Bitcoin? There are many people that say no, right? Just buy and hodl and just be okay with the volatility. That does work if you don't have too much exposure to Bitcoin. But if your net worth is several years of your income and you want to have the majority of that in the fastest growing of the asset classes, then an 80% drop doesn't feel right. Now, there are several approaches that worked incredibly well in the past. Will they also work in the future? Nobody knows. But it is probably better than just random guessing. It's probably better than gut feeling. One of those approaches is shown here. This is the realized price. It's the average cost basis of the market. If the market, in average, is in losses, it historically was a very good time to buy Bitcoin. Because most people that get into Bitcoin long term, they believe in the asset to appreciate over time because of its limited supply, right? Fiat currency expands by roughly 6.8% per year. Bitcoin expands much slower, thus measured in US dollars, it should go up long term. And so if you're as an individual currently in losses, you're just waiting it out, right? You're just waiting for the price to recover to then later sell. In other words, if the market in aggregate is currently in losses, the sell pressure tends to subside. And it's a very, very good time historically to buy. We can also get a bit more complex. We can have a look at how much the market is currently in profit relative to that average cost basis. And we can take that profit and put this again in relation to the volatility, as in how much is the price going up and down? Do we have low volatility, so our price is rather stable, or do we have high volatility? Are they going up and down all the time? If we've got high volatility, we can afford to be more in profit. If we have low volatility, we might want to take profit earlier. And so that is what the market value to realized value Z-score is measuring. We're looking at how much is the market in profit. We put this in relation to the current volatility. And whenever we are very high on this metric, it might make sense to take some chips off the table. When we are very low, again, it's a great time to buy. Here's another way to look at very similar data. So this looks now at the net unrealized profit and loss. If the market in aggregate is currently in losses, we want to buy. If the market is in net unrealized profit, especially in high profit above 75%, we might consider selling. At least historically, this worked very, very well. And here's another measure. This shows very similar bottoms and peaks, but the indicator is calculated quite differently. It's the realized HODL ratio. This looks at how much trading volume is there currently between the short-term holders versus the long-term holders. If it's mainly short-term holders that are currently active, this is high. So it means everybody is hyped about crypto. If nobody looks at crypto and it's only the long-term holders that are trading, then we want to buy. So again, a quite nice indicator that historically worked well. Now there's a bit of a problem with indicators like this. The first problem is that we don't know if they continue to work in the future. But the second problem is that most of those indicators say that we are not particularly cheap right now. So if we buy into crypto at the moment, we are betting on the positive momentum. We are not betting on particularly cheap prices. And if we take that insight together with what we talked about at the beginning of this video, that Bitcoin can, in the extreme cases, drop by 70 or 80%, it makes the case very hard to go heavily into the asset, right? To have half of the entire net worth just in Bitcoin. And so let's come back to the idea of risk to reward. What is the potential risk? How much lower could we fall? What would happen if the long-term holder suddenly decided to sell again and we enter into another bear market? Here are a few models for potential flaws. This is the cumulative value days destroyed. It historically marked the bottom of a bear market very, very well. And currently that price is at 34K only. Then again, we've got our realized price. That's at 45.5K. Then we've got the balanced price, also a pretty good bottom indicator in the past. That's now at 35K. And we've also got the long-term holder realized price. That's currently at 32K. And so based on those models, it appears as if the risk for Bitcoin is very, very high right now. But the problem is we don't just want to be invested with very low quantities, right? We want to be invested massively because long term, of course, crypto tends to appreciate much faster than property or stocks. The problem is even worse when we are in altcoins. So let's have a look at this here. This is the Bitcoin price history up until the middle of October of 2021. And when we see a chart like this, it doesn't necessarily look bad, right? We're just potentially going to new heights. But unfortunately, subsequently, we saw a massive drawdown, right? To our 15 to 16K. That was the 76% drop we mentioned at the beginning of this video. But for altcoins, it's much worse. What happened since November 2021 to Solana, for example? Solana went from $260 all the way down to $10. That was a drop of 96%. You have lost pretty much everything. And so that then makes the case even stronger that we should even bet less on the altcoins. We already can't bet that much on Bitcoin because it's historically high. We can't even bet on altcoins because when they go down, they crash massively, even something like Solana. And so again, what's the solution to this problem? Why am I currently invested despite all of those charts? The reason is, I think there is a way to minimize risk. There is a way to cut losses early enough. We can be exposed to the upside while limiting the losses in case we don't go up. And again, the way I do this is using statistics. What we see over here is the 120-day simple moving average. And the strategy is straightforward. We want to bet on falling prices or at least be in cash when the Bitcoin price is below that moving average. And when it's above, we want to be exposed to the market. That's when we are long. That's when we also potentially trade the altcoins. So this is a trend following strategy. We're never going to buy the exact perfect bottom. We're not going to sell the exact perfect top. We are simply just following the trend. Now, why do we take the 120-day simple moving average? Why not the 200-day or the 100-day or the 50-day? The answer lies in this over here. So I've backtested various moving averages from the 2-day all the way to the 200-day to figure out if you follow that strategy, what's actually the best moving average duration. We also include trading fees of 0.2%. We go both long and short. Here's the moving average duration. Here's the annualized performance. The data starts in August of 2017, and here is a graphical representation of the backtest results. So on the x-axis, we've got the moving average duration. It goes from 2 days to 200. On the y-axis, we've got the annualized performance over the testing period. Buying and holding through that time would have given us 28% per annum, which I think is a pretty good long-term target for Bitcoin's performance in general. And it tells us that the moving averages below 30 days tend to underperform, maybe because of the trading fees. It also tells us that pretty much every moving average above that tends to do better than buying and holding. And the 120-day historically worked by far the best. Here's the performance over time. So in white, we see the Bitcoin price, and in turquoise, we see the development of the backtested portfolio. Now, this is on a linear scale. We don't really see what happened in the early days, but we also have this here on a logarithmic scale. And again, the performance using that long and short strategy in Bitcoin using the 120-day SMA is incredibly steady. It goes through the 10 axis almost like clockwork. And so that's what I like doing, right? Even though Bitcoin might historically be relatively expensive, as long as we stay above the 120-day simple moving average, I think it makes sense to be rather risk on. We don't have to get crushed by those 75% crashes. We just exit early enough. Yes, we might have a failed signal here and there sometimes, but those kind of failed signals are nothing in comparison to how much the price went down during the bear market. And so when we reduce the risk in this way, right, if our down moves aren't that big because we sell very early, once we fall below that moving average, we now can afford to have more exposure to Bitcoin. We don't need to have only 10 or 15% of our net worth in Bitcoin. We now can increase it because in case we turn around, we're just selling a lot. The same argument can of course then also be made for the altcoins, right? When Bitcoin is going down, then a lot of altcoins go down as well. And that way we then sell Solana early enough, not when it's at $10, but much earlier. Actually, let's have a look at this. So Bitcoin crossed the 120-day simple moving average over here on the 3rd of December 2021. And that corresponds with a Solana price of $212. We then had our failed signals. Let's ignore them. Let's then say we buy back in over here on the 12th of January 2023. That's over here. That's when Solana's price was roughly $16. So we avoided a crash of 92%. If we are out of the market, when the momentum turns around and when we might get closer to the realized price again, we can have 10 times more money for the next bull run. We are avoiding that much of a crash. And again, that then allows us to get more risk on, right? That then allows us to not just have a few dollars in Solana or in some meme coins potentially. It gives us the flexibility to take all of the growth while minimizing the downside. That's what we want, right? We want to get the best risk-adjusted return. We want to reduce the risk and still have the same return. Now let's zoom out a little bit and have a look at the macro picture. We actually see an expanding crypto market, money flowing into the market since October of 2023 already. We know this because of this data over here, the stablecoin market cap. It's currently going up. Before October of 2023, it tended to go down. And the way this data is generated by looking at the minting and the redemption of stablecoin. So fundamentally how this works is when you deposit your hard-earned fiat currency to a centralized exchange, then that centralized exchange will send over the fiat currency to a custodian, to a stablecoin issuer. And that custodian, so be it USDC, so Circle, or Tether for USDT, that custodian will hold the funds in a dedicated account and then will create tokens. So that's what's happening when this chart is going up. Whenever you're withdrawing your funds, then of course the custodian has to release again the fiat, send it over to you via the centralized exchange, and that's when we go down. And there's a reasonable case to be made that the more money is in a system, the higher the prices should go. Have a look at this. This is Bitcoin since October of 2023. And the largest drawdown we have seen while money was still flowing into the market was 28%. But again, when money is flowing in, those dips tend to get bought up. Now, what are those green circles over here? They appear after a price rally. It's an indication when there's a lot of attention on crypto. So there was a spike in search interest for Bitcoin at the beginning of March of 2024, but also at the beginning, middle of November of 2024. So that's what's highlighted with those bubbles. The masses tend to be late. The masses tend to buy after a price rally. And that's a problem, right? Most people enter crypto when prices are high and then potentially comes at least a short-term correction. And then a lot of those people that got excited about Bitcoin first have to ride through that correction. It can be minor, since currently the market still expands, but it can also be major, of course, as we have seen with prior attention spikes. And so there are two fundamental forces that move the crypto prices. First of all, it's the money in and outflows, but it's also the swapping activity. So once there's capital in the system, people tend to swap in and out of Bitcoin, but also in and out of the altcoins. And whenever we deploy, say, $100 worth of stable coins, the market cap of a crypto asset rises more than that. There is some inherent leverage effect. And that means we can measure how much the market is currently risk on or risk off. What we've got over here is the stablecoin dominance. So it's not the stablecoin market cap, it's the stablecoin dominance. It measures how much of the entire cryptocurrency market cap is currently in stablecoins. When this is very high, the market is risk off. So a lot of the market cap is in stablecoins. When this is very low, the market is very risk on. And in the last 1.5 years, we tended to trade in a range between 5% stablecoin dominance and 9% stablecoin dominance. And surprise, surprise, when the stablecoin dominance is high, it means crypto prices are very low. When the stablecoin dominance is low, crypto prices tend to be high. So interestingly enough, whenever the stablecoin dominance is low and when prices have already gone up, that's when the tourists enter and first get burned. So we want to be counter-cyclical. We want to sell when stablecoin dominance is low. We want to buy when stablecoin dominance is high. And it very much looks like we are currently on the way to seeing more stablecoin deployments. In other words, the current positive rally is probably going to continue. I don't have a crystal ball. It's just the way how I interpret the data. And then the question is, does it make sense to just buy Bitcoin if we expect prices to go up, or should we rather go with the altcoins? Now, some altcoins can do phenomenally. Others tend to underperform. But let's have a look at, for example, Virtual. Virtual went up by almost 3x in the last month. But I think it's better to try to find those altcoins very early. So the real gains had been made in the early days, right? When we look at the all-time chart of Virtual Protocol, those gains are immense. 20,000%. And so the life-changing money is not necessarily just in riding the current wave and buying a broad basket of altcoins. It's trying to find approaches to get into those altcoins much earlier than most. And I think a very good approach is to look at people that tended to buy well-performing assets early in the past. So for example here, right, this is Brian Young. He bought a Virtual Protocol token at 7 cents. And that was on the 21st of March 2024. So that's over here. We subsequently saw a rally of more than 6,000%. And so here's his YouTube channel, right? He's got more than 2 million subscribers. It of course begs the question, is Brian Young just more skilled, or does he have sufficient impact on the prices? Because maybe some of his following is buying into the token as well. I don't know, but it's always valuable to know what those kind of people are doing. The way how we knew about Brian Young buying into the token at that time was not because he announced it that early on his channel. It was because we track his wallets. We've got 5 of Brian Young's wallets. In total, we track almost 600 influencer wallets. So we've got also wallets by Alex Becker. He's got 1.6 million subscribers. We are also tracking the Crypto Banter channel. They've got 1.2 million subscribers. And again, I think it makes sense to be very early with the insiders and with the people that move the market. Now, of course, not every single token that's purchased by an influencer is going to rally. Some tokens are just bought and never announced on the social media, so we don't have the purchases by the following. But if you want to have a chance of being early, if you want to get the 10 or 20x returns, we can't just buy what's already big, right? We have to buy the things that the smart money is buying as well. And so here are a few examples of trades that our community has made. We discuss the influencer trades. We discuss potential opportunities to bet on rising, but also to bet on falling prices, depending on market conditions. And so, of course, we track our influencer wallets, but there's also a tutorial section on just how to find those influencer wallets. There are various approaches through NFTs, through related transactions, through deposit addresses on centralized exchanges. There are 8 tutorial videos in total. And so then the community is trying to figure out what wallets that we are not yet tracking can we potentially add to our bot. So there's a dedicated wallet research chat. We've just added influencer Chicken Genius. And then every day we get signals when influencers buy and sell. Selling is also important, right? Most people don't publish when they sell. It's very interesting. Some people just buy, publish a video on an asset, and then sell just a few hours afterwards. They literally pumping and dumping on the audience. It's quite nice to look behind the scenes. And so feel free to check it out. It's down below. It's thebitcoinstrader.com. Currently the price is $125 per month. It went down because search interest in crypto is now rather low. Once we are up again, the price of course will get increased, but not for the people that are already subscribed. So once you sign up for $125, that price is locked in. So here's my recommendation. Don't wait until attention is again at those heights. We are still early. The market is expanding though. Macro is positive, but you don't want to wait until the rally has already happened. Right now, attention is still low. The rally is likely going to continue. As said, there's still money on the sidelines. The stablecoin dominance has room to further fall, which will result in rising altcoin prices. It's just about figuring out what altcoin has most upside. If it's your first time here, feel free to subscribe. I publish videos regularly. A like would be very much appreciated as well. It helps the channel grow. See you next time on YouTube or see you in premium. The link is down below, thebitcoinstrader.com. There should also be a link directly here on the screen where you click on that link, then it will lead you directly to the page. See you next time. Bye-bye.